Welcome back. Today, we're diving into one of France's most important long-term investment tools, the Plan d'Epargne Retraite, or PER. If you're looking for a way to save for retirement, reduce your taxable income, and grow your wealth over time, this account is a powerful option. Before we dive into today's topic, please note that the information provided in this video is for educational purposes only. It is not financial, investment, or tax advice. You should always consult with a licensed professional before making any financial decisions based on this content. But how does it work? What are the different types of PERs? And what should you consider before opening one? Let's go step by step and break it all down with clear explanations and real-life examples. What is a PER? A Plan d'Epargne Retraite, PER, is a long-term savings account designed to help individuals prepare for retirement while benefiting from tax advantages. The main idea behind the PER is simple. You invest money over time, and in exchange, you get tax benefits and a structured way to receive your savings when you retire. There are three main types of PERs. Per individual, PERIN, a personal retirement plan open to everyone, whether you're an employee, self-employed, or unemployed. It is the most flexible and commonly used type of PER. Per collectif, a company-sponsored plan offered to employees, often including employer contributions as an incentive to save for retirement. Per obligatoire, a mandatory retirement plan provided by an employer to certain categories of employees with fixed contribution rules. Each of these plans has its own rules and advantages, but they all serve the same purpose: to help you build a solid retirement nest egg with tax incentives and structured withdrawals. Investment options in a PER. The money you deposit in a PER isn't just sitting there, it's invested to generate returns over time. Depending on the provider, you can choose different types of investments: stocks, shares of companies, higher risk but higher potential returns. You can invest in French or international companies depending on your provider. Bonds, government or corporate bonds, a more stable and secure investment, but with lower returns than stocks. ETFs, exchange-traded funds, a mix of stocks and bonds for diversification, offering lower fees than actively managed funds. Mutual funds, professionally managed funds with varying levels of risk depending on the investment strategy. Real estate investment funds, SCPI, OPCI. Some PRs allow investments in real estate assets, providing diversification and potential steady returns. Structured products. Some PRs may offer structured financial products that provide specific risk-return profiles. Most providers offer managed portfolios based on your risk tolerance and time horizon. This means your investments are adjusted automatically over time to become less risky as you approach retirement, ensuring better financial security. Benefits of the PER. So, why should you consider a PER? Here are some of the biggest advantages. 1. Tax-deductible contributions. One of the biggest perks of the PER is that the money you invest can be deducted from your taxable income, reducing the amount of taxes you pay each year. The annual deduction limit varies based on your professional situation, but generally represents a significant tax-saving opportunity. Example: Pierre earns $50,000 per year. He deposits $5,000 into his PER. Instead of being taxed on $50,000, he's now only taxed on $45,000, which lowers his income tax significantly. 2. Long-term growth and compound interest. Since PER investments are meant for the long term, they benefit from compounding interest and market growth. The longer your money stays invested, the more it can grow. Example: Claire starts contributing $3,000 per year to her PER at age 30. By the time she reaches 65, assuming a 5% annual return, she will have over $250,000 in savings, largely thanks to compound interest. 3. Multiple payout options at retirement. When you retire, you can choose how to receive your savings. Lump sum. Withdraw all your money at once, fully or partially. Annuity payments. Receive regular payments like a pension. A mix of both. Combine lump sum and annuities for flexibility. 4. Portability. Your PER stays with you even if you change jobs, become self-employed, or take a career break. Drawbacks of the PER. While the PER has many benefits, there are some downsides to consider. 1. Locked-in funds. Unlike a livret A or a CTO, you can't withdraw money freely before retirement, except in specific cases such as buying a primary residence, severe financial difficulties, disability or death, business liquidation for the self-employed. 2. Taxation on withdrawals. When you withdraw money at retirement, it is taxed. The tax depends on whether you receive deductions when making contributions. Capital gains are also subject to social charges. 3. Investment risks. Depending on how your funds are invested, your savings could fluctuate with market conditions. How to open a PER. Opening a PER is straightforward. Choose a provider. Banks, insurance companies, and online brokers offer PERs. Select an investment strategy. Choose between managed or self-directed investments. Start making contributions, regularly or through lump sums, based on your financial goals. How to close or withdraw money from a PER. You usually withdraw from a PER at retirement, but there are exceptions. You can access funds early for buying a primary residence, severe financial difficulties, disability or serious illness, business liquidation. How is a PER taxed? The taxation of a PER depends on whether you deducted contributions from your income. If you took tax deductions, withdrawals are taxed as income, but capital gains are taxed at the PFU, 30%. If you didn't take tax deductions, only capital gains are taxed at the PFU, 30%, making it more attractive for those who want tax-efficient withdrawals. PER versus other investment accounts. How does a PER compare to other savings and investment options in France? Livret A, more liquid but lower returns, currently around 3%. PA, Plan d'Epargne en Action, ideal for stock investing, tax advantages after 5 years but no specific retirement incentives. Assurance V, more flexible withdrawals and succession benefits, but no immediate income tax deductions. CTO, Compte Titre Ordinaire, no tax advantages but access to all investment types. Final thoughts. Please note that the information provided in this video is for educational purposes only. It is not financial, investment, or tax advice. You should always consult with a licensed professional before making any financial decisions based on this content. The PER is an excellent tool for long-term retirement savings with tax advantages. However, it's important to understand the restrictions and risks before investing. If you're looking for tax-efficient retirement planning, the PER might be perfect for you. Would you like to know more? Let me know in the comments.